What we're doing is just a couple of these state of the markets addressed to keep the audience a little bit more tight-knit so that if there's any questions, especially after everything that we went through last year, we want to make sure that we're here to answer those. So I'm just going to get right into it. Everyone's got the slides in front of them. But at any point in time, if you have any questions, don't hesitate to just interrupt me. Like I said, you're not going to offend me at all. I'm here to give you education. My name's Andrew Whalen. I'm the CEO of Whalen Financial. We run a registered investment advisory firm managing about $130 million across 2 different states and clients all throughout the United States. So don't hesitate to just interrupt me because I'm going to go through a lot of detailed information, a lot of analytical things, which most of these people in the room know. I'm very analytical. And I could talk about this stuff all day, so I try to bring it into a presentation that's a little bit user-friendly. So this one right here is the disclosures. Got to keep the regulators and the attorneys happy, so if you could quickly read all of that, okay, we'll go to the next one. So today's agenda: how did stocks perform in 2018? What drove the market performance in 2018? Where are we right now? This last week was a little bit volatile with the S&P dropping about 1%. And what do the experts that we follow and we build models around, what do they expect for 2019 and moving forward? So just to kick it off, I have to use this as a presentation tool, so I'm not texting my girlfriend or anything, so just letting everybody know. This looks at all of the top money managers around the United States and the world, and basically looked at their 2018 forecast, where they saw the S&P 500. The S&P 500 is the major broad index, represents 500 companies here in the United States. And this is basically where everybody thought the S&P was going to finish last year. So instead of going down all the way the list, what I want to focus on is kind of just the average. So the average group saw last year's S&P 500 growing by roughly 4%. The actual results was a close of 2506, 6.2% loss. And when you add reinvested dividends, if you buy the S&P 500, that's another about almost 2%. So total return was a negative 8.2% loss, roughly. Very far off from what they were expecting for growth last year. And there was a couple of factors that really contributed to that. And these are the ones that we want to focus on for our clients because they make most of the headlines, right? In a day and age where the news is 24 hours a day, thrown in your face from your phone, from your tablet, from your computer, definitely from the television. These were the ones that really piqued a lot of interest. So that's the trade tensions, not just China, that's the most popular one now, but remember we got into a little sniffle with Mexico and Canada last year, as well as other parts of the country. Interest rates, the Federal Reserve will go into that. They raised interest rates a number of times last year, and how does that affect the overall economy? Midterm elections, that was a big thing. The House swung to the Democrats, the Senate remained Republican, and we'll talk about how that kind of shifts policies a little bit, or how it will not shift policies, and how that is going to affect the economy moving forward, at least until the major election in 2020. And then lastly, you may be unfamiliar with this, but it's a big leading indicator of a recession, and that's what's called yield curve inversion. And that's essentially when the short end of treasuries start paying more than the long end of treasuries. And that happened last year. So we'll dig into the details of that. Just to kind of keep it simple, this is January to December of last year. And if you can't really read all of these, that's why we kind of try to print things out for you, so hopefully you can see them. But essentially this marks the whole calendar year. And dark green, as you can see, the dark green here and here, up through there, those are all trade tensions. We'll go over those. I think trade and interest rates were the biggest factor in the market's underperformance last year, and some of the biggest culprits for maybe what we call the headwinds moving forward in 2019. Interest rates, those are interest rate movements and the dates, March 22nd, June 14th, September 27th, and then the famous one on December 1st. And then midterm elections, we have 2 of those there. The October sell-off, biggest loss of an October in 7 years, and that was right feeding into the midterm elections. And then obviously the midterm election November 6th. And then lastly, the yield curve inversion, which happened right at the end of the year, almost at the bottom of the correction that we went through, or what we call the bear market that we went through. So December 24th was the end of the bear market, or the bottom. So if Reed didn't buy on December 26th, the first trading day, or if I didn't, then you call us, because our crystal ball wasn't really working that day. But that was the exact bottom. The peak was September 21st of the S&P 500, and from September 21st to December 24th, the market fell 22%. A drop of 20% or more is considered a bear market, okay? Here were some of the dates that led to the trade tensions with China. I'm going to leave these up, just a few that I kind of want to point out. It really all started in March 23rd. If you remember, last year the market started to sell off in February. March 23rd, the U.S. imposed a 25% tariff on steel and 10% on aluminum. Quickly thereafter, a week later, China said, enough of that, we're going to do the same thing. But the only problem is we import a lot more than we export to China. So we had all the leverage, at least in that relationship. So you'll see we do 34 billion, they only do 16 billion, right? Because they just don't have as many goods that they can add tariffs onto. Down into September 24th, the U.S. imposed additional tariffs of $200 billion. It's a tremendous number on Chinese goods. And that same day, China responded with $60 billion worth of U.S. exports. And then finally, we got some good news. The G20 summit meeting, December 1st, U.S. and China agree to do a trade halt, essentially. So no further increases of tariffs, and that's when the negotiations really started. They did that for a 60-day period of time, or 90-day period of time, and what we think is going to happen this March is they're going to extend that out probably another 30 or 90 days. The good thing is that they're not imposing more tariffs, because the more that they do, the more volatile that the market becomes. So there is some reality in the trade tensions. First, there's a lot of headlines that are out there, but there are some positives. So if we look at some of the positive things that happened last year from the trade scuffles, is what we'll call them, is at the end of the day, China and the U.S. are starting to work on some type of resolution to make progress. Here on the home front, the United States added manufacturing jobs, even after imposing the steel and aluminum tariffs. And if you look at the U.S. and Mexico, they finally did reach an agreement on the U.S.-Mexico-Canada agreement, which basically opened Canada's dairy markets to the U.S. farmers, as well as started to resolve the auto tariff issue that was unfairly placed back with the NAFTA agreement. So there are some positives to this, even though there is some short-term pain. So we've covered trade tensions. This is interest rates, okay? So just so everybody knows, why are interest rates a big deal? Interest rates act like gravity on asset prices, okay? So the higher the risk-free rate of return is, let's consider it a CD or a 10-year treasury, the lower stock dividends, or the less attractive stock dividends are, okay? And that goes across the board with all asset classes. So you saw the Fed raised interest rates 4 times last year. Since December of 2015, when they started raising rates, they've only raised them 9 times in totality, 4 of which were in 1 year last year. And if you saw the news at all, a lot of people were saying, man, the Fed's getting a little bit too aggressive in raising these interest rates. Think back to the 1980s, the late 70s, early 80s, when Paul Volcker was aggressively raising those interest rates. And what happened was it tipped us into a recession because inflation really got fairly rampant at that point in time. So that was the big concern with interest rates. But remember, the Fed is raising interest rates in response to a strong economy. So you have to also look at the pros as well as the cons, but you saw a lot of problems in interest rate sensitive instruments such as housing, mortgages, auto loans, availability of credit because of higher rates. So as you can see, as they raise interest rates, there are some negative effects that happen in the overall economy. And that was one of the big concerns last year. Like I said, were they raising rates too far or too high too quickly? And what was that going to do to the overall consumer? And as we know, GDP is made up of 80% consumption. So if it costs me more to get a mortgage, then I'm less likely to be able to purchase a home, which is why most everybody in this room probably saw their home values on Zillow, we'll say, drop by maybe 7 to 10% last year, just because it was harder for people to qualify to purchase the homes. Next is recessions and bear markets. That's what everybody wants to know, right? So typically, you can see we've had 11 bear markets. If we count this last one, that would be 12. But we bounced right off of that low and came right back up. So we're not technically considering it a bear market, even though we dropped 20%. But we did see we have seen 11 bear markets in the history of the United States, going back to 1926. And this kind of outlines all the different recessions that coincide with the bear markets. You can see typically when a bear market starts, that's a leading indicator of an oncoming recession. But the most important thing is to keep things in perspective with regards to the U.S. recessions and the declines from the all-time highs. You can see the Cuban Missile Crisis, the 1987 flash crash caused the 20% decline in the market, and then most recently this one, which was in 2018 of last year. Next thing, yield curve inversion. So what does that mean, right? So yield curve inversions essentially mean when the shorter end of the yield curve is paying more than the longer end of the yield curve. That happens as the Fed raises interest rates. Essentially last year in December, a 2-year treasury was paying more than a 5-year treasury, and a 3-year treasury was paying more than a 5-year treasury. You can essentially get more money by giving the government your money for 2 years than you could for 3 or 5 years. And the reason why that's a problem is because that means investors, not retail investors, but institutional investors, are not wanting to take a lot of risk on the long end of the yield curve. But not every yield curve inversion is created equal. And what I mean by that is the one that is always historically going back to 1970s, the leading indicator of an oncoming recession is the 2 and the 10, the 2-year and the 10-year. When you have that inversion, that's generally a leading indicator of an oncoming recession. So what this chart shows is every time on the left-hand side, the 2 and the 10 curves inverted. So 78, 80, 88, 98, 06, okay? Then the second column is basically from that time when it inverted, when the S&P 500 peaked, when it reached its highest point before a recession. And you can see the average is about 13 months, okay? Some of them go a little bit longer than that, like this one in 1998 that lasted almost 2 years. But the average is 13 months. But what I wanted to point out is the rate of return, okay? So from the time that the yield curve inverts to the time that the S&P 500 peaks, it was about 13 months and a 22% rate of return for the S&P 500. So just because it inverts doesn't mean, hey, it's time to go to cash. Just because it inverts doesn't mean that we have to get overly worried. But it's something that you should have a conversation with us about if that starts to happen on ways that we need to reshift the portfolio. Only because it's always been a guaranteed leading indicator of an oncoming recession. So this is a big thing that happened in December for the first time, December 1st, which really accelerated the loss from December 1st to December 24th. But right now we have a spread, a difference of about 40 basis points. Seems very small, so 0.40%, but it's still positive. And like I said, from the time it inverts to the time recession hits is usually about almost over a year. So we still haven't seen that yet. So we covered some of the big things that happened last year. The trade tensions, interest rate movements by the Federal Reserve, the yield curve inversion, and now we're going to look at kind of where we're at right now. So this is something that we put together at Wayland Financial to make it really easy. All right, everyone knows what a speedometer looks like, right? So essentially, there's 20 indicators here that we've created at our firm that monitor economic activity in the United States as well as abroad. And basically, as you can probably imagine, green means it's all good. Yellow means there's some caution on the horizon, and red means there's some big trouble ahead. And what these indicators look out are only 3 to 6 months. So it's very short term. But as you can see, this is December of 2008. This is only 4 months, 4 months from the bottom of the 08 crisis, which was March 9th of 2009. And as you can see here, almost everything is in red. What is not? Monetary policy. That's the Federal Reserve. Why? Because they were cutting interest rates at that point in time. That's positive. Equity market valuations is in green. Why? Because everything sold off so low by that point in time. But everything else, disposable personal income, job creation, one of our favorite, which is ECRI, Leading Indicator Index, Economic Outlook, Global Economic Outlook, tax policy, company guidance, volatile. You can read all of them. They're all in the tank. So now let's flash forward to January of 2018. Same indicators. Here we see consumer sentiment is high. That's positive. We see monetary policy is easy. That's a positive. We see corporate profit growth still in the green and a positive. Interest rates are right in the middle, but they expected the Fed to raise 4 times last year, so you can kind of start to see that slide. The only one that's in the red, for obvious reasons, is geopolitical risk going into January of 2018. Brexit, the EU, China, Korea, those are all big factors, but the only one that was red was geopolitical risk. So now let's flash forward to December of last year. So December of last year, you just lived through 22% decline in the market, and this is what the chart looks like. Our leading indicators that we follow. Again, the only one still in the red is geopolitical risk. Now, that doesn't mean that the global economic outlook, which we're worried about Europe a lot, not losing any sleep, but if something doesn't happen by March 29th, Britain is automatically out of the European Union. They've been trying to get a no vote for the last 3 years, and have been unsuccessful. They've been trying to get Theresa May out of there for the last 3 years, unsuccessful. And I can tell you, if it happens automatically, there's going to be some volatility in the market, right? They go back on the pound, right? They have to renegotiate trade contracts on their own. Immigration policy is now back on their own. So geopolitical risk is definitely something that we want to keep in mind because it affects the global economic outlook. And as the globe slows, it's hard to see the globe slowing down and the U.S. not being affected in some way, regardless of how resilient we are as a country or an economy. So one of those indicators is our favorite. This is what's called the Leading Economic Index. So this looks at 10 components from stock prices to manufacturing to consumer sentiment, and it puts it in a nice, smooth line. But what I want to point out is the trend in the last 12 months is still positive. You can see that slope is gradually increasing from left to right, okay? And one more thing is all these red vertical bars are recessions, and this goes back to 1950 something, roughly. And I want to tell you the exact dates. I don't like guessing. It doesn't tell me. So we'll just say 1959. That's the closest on the left. So recessions are indicated by these red lines. What you'll notice here is there has never been a recession when this leading economic index is gradually increasing, okay? So you'll see at the, let's say, I wish I had a pointer, but you can see here, there wasn't a recession until this leading economic indicator index dropped down. So what this indicates is that there's still more growth ahead for at least 2019 for an economic standpoint in the United States, which is a positive. So we like to make it really simple here. We like to focus on like a plane, a headwind, and a tailwind. Headwind, it's going to take you a lot longer to get to New York City, right? Tailwind, coming back to Vegas, you may get home a lot sooner, right? Even though I think it works the opposite way. It's the other way, but yeah, you get the concept, right? I do numbers, I don't fly planes. Yeah, right, yeah, exactly. So in 2019, here are all the headwinds that we could see, kind of slow economic growth in the United States. Brexit definitely just went over that. I think there are going to be some problems in there March 29th if they don't get a resolution. Consumer sentiment started to slow down at the end of 2018 as they saw their stock valuations or their portfolios go down 10, 15, or 20%. It got their sentiment about investing a little bit lackluster. Geopolitical risk, I already went over that. That's pretty big because it can affect the global economy. Again, growth slowing in Europe. Housing can be somewhat of a problem if the Fed still puts its foot down on the accelerator for interest rates. And we already saw the results of those just from 4 interest rates movements last year. Monetary policy. This is a big thing only because what really shook the markets from December 1st to December 24th was the Fed came out and said that they still expected to raise rates 3 to 4 times this year. And the market really took that as a curveball. Now, since then, they've come out and said we're basically at a wait-and-see approach. They're going to wait and see how the economic numbers are doing, how inflation is doing, because all of those things are part of their individual mandates to monitor the monetary policy. But you'll notice housing and monetary policy are on both headwinds and tailwinds, depending on what happens with interest rates. And then wage increases. So it's good for everybody if they're making more money, but bad for corporate bottom lines, right? And earnings is what drives stock prices. So this actually gets to, I'll get into that in just one second, but here are some of the tailwinds that we think are things that are going to continue to move economic activity forward. Credit availability, bank liquidity, asset reserves under banks, unlike 2007 and 8, that was basically zero, right? They were over-levered, providing too much credit. Right now, credit's relatively available if you've got assets to secure it by or a positive income statement. Consumer spending, if no one saw the news in December or in January, we had the highest Christmas season that we've ever recorded in U.S. history. And that doesn't tell me that the consumer doesn't have money in their pocketbooks to spend. Now, granted, at the same time, we saw credit card debt reach the highest levels that we've ever seen in U.S. history. So either they're using all of the credit cards and maxing them out to boost those numbers up. That's a little bit of a toss-up, but consumer spending is definitely a tailwind. Corporate profits, all-time high in corporate profits. Despite the earnings recession that we started to see last year, corporate profits still at an all-time high. Why is that good? Because they have the ability to reinvest those profits into research and development, develop new products. Think of Amazon as an example. The higher their profits, the cooler the products, is what we like to say, that they can come out with. Equity market prices are definitely a tailwind, and I'll get into that in the next slide. Housing and interest rates and the labor market is pretty robust right now. And then lastly, monetary policy. But the reason why housing is a headwind and a tailwind is because interest rates are still relatively low. But as the Fed increases those interest rates, it leaves a lot of room for exposure on credit availability for qualifying for the home, as well as if you remember last year in the tax code, they minimized the deduction cap. They decreased it a little bit, which doesn't make it as incentivizing to purchase a new home or purchase multiple homes. So it's both a headwind and a tailwind. Okay, now the fun stuff, right? So equity valuations. Everybody wants to know the market is overpriced. It's extremely overpriced. We look like we did in the dot-com era. We look like we did in 2007 and 2008, 1929. Well, no market valuation was ever higher than 2000 to 2002. You can see here, this is what's called price to earnings. This is how we judge the market or an individual stock. You essentially take the price of the stock and you divide it by the earnings of the stock, and it gives you a multiple, okay? And the higher that multiple is, the more expensive the stock is relative to how much they actually earn. So you can see in the 2000s, we reached a peak of 27. In 2008, we hit a peak of about almost 16 times. And then currently you can see we're currently at 14.4. Now this is as of December 31st. We've seen about a 9.5% rally so far this year in the stock market. So now we're at about 15.8. But you can see, and why we use the 25-year average is because it includes a lot of those peaks and troughs of high valuation. But we're still well below the 16.1% average. Meaning that we're not extremely overvalued from price to earnings. Now this is just a broad range for the S&P 500. Sure, things like Amazon are higher price to earnings multiple than, let's say, a Berkshire Hathaway or a Home Depot. But overall valuations are still relatively healthy, and I would argue anyone that said that they were frothy. So now the most important part. Where do we think the markets are going to go in 2019? So, big thing, inflation, right? Too much inflation stifles growth, right? Things cost too much too quickly, we can't keep up with it. Too little inflation stifles expansion, right? If things aren't growing the prices at a right rate, then I'm not able to increase my revenues by charging more for certain products. Not mine personally, just the company in general. So right now, we changed, the CPI came in at 2.2. Historical inflation is 3.3. So we're still well below inflation. I don't think the Federal Reserve has to worry much about inflation, at least not in the short term, which is why I think they're taking a wait and see approach to raising interest rates in 2019. But this kind of shows you, which is just interesting, the year-over-year changes in how much your house increased, purchasing power, energy, food. You can see the biggest one was energy last year, next to rents. So rents were the biggest winner for inflation. So if you own buildings that you rent out, or if you've secured new leases at a commercial property, your rents probably went up year over year. And it's because the market can justify it. But what we look at, we can also see 0.8% real average hourly earnings. It's a little bit below the historical average of about 1. But I think that's going to pick up based off of this next slide. Oh, next one. So this is very important. So interest rates for 2019, okay? As the Fed raises interest rates, everybody thinks that equity valuations will go lower, right? Remember what I said, as interest rates go higher, it affects asset prices across the board, specifically interest rate sensitive. So let me explain this because this is probably the most important one because you see a lot of headlines about the Fed raising interest rates. So let's look at the actual facts. So every one of these little dots is a year, okay? Going back to 1963. Down below on the bottom is the 10-year Treasury. Okay, so 10% on a 10-year Treasury, 8%, 6%. That vertical dotted line is 5%. Okay, and why that's important is what you'll notice is when the Fed is raising interest rates, which is that upper half, okay, where are all of the dots oriented? They're oriented in that top left, right? And what that means is there's a positive relationship between interest rate increases and stock market returns when the 10-year Treasury is below 5%. So as long as that 10-year Treasury is below 5% and the Fed is raising interest rates, historically, it's positive for stocks is what that means. Right now, the 10-year Treasury is at about 2.7, 2.8. So we've got a lot of room to run until we hit about 5%. So what this essentially means is anytime the 10-year Treasury paid more than 5% and the Fed was raising interest rates, it was a negative relationship. Does that make sense? But anytime they've been raising interest rates and it's below 5%, it's generally a positive, except for a few of these cluster years right there, if you notice that. I think I just blinded myself a little bit. But does that make sense? Because that's really important because you read a lot and everyone gets things confused about raising interest rates without looking at the text or the facts or the data behind where interest rates are now historically low compared to where they were over the last 50 years. So it's just very important to keep it in context. GDP. Okay, we went gangbusters last year with GDP. They haven't come out with the fourth quarter numbers yet, but we're looking at 2.9%. I think it'll be revised a little bit higher, about 3.2. But 2.9 to 3.2 is probably where it's going to come in at because of that strong consumer spending in that fourth quarter. But if you look at the quarters by the years, we only did the last 4. Something important to point out is 1.6% in 2016. I think, and Reed, you can correct me if I'm wrong if you know the facts, but from 2009 to 2016, we only averaged 1.8% GDP growth in one of the greatest bull markets in U.S. history. You can take that at face value, but it's pretty pathetic. So 1.6% annual GDP growth in 2016. Then we started changing policies, mostly economic policies, and we started to see GDP tick up. Now what we're estimating for 2019, from what I can tell, is somewhere around 2.6. Yes, it's a little bit lower than last year, but significantly higher than the previous two. So we still see economic expansion, maybe not as high, maybe not as much, but definitely not negative. Remember, a recession is defined as 2 negative quarters of back-to-back negative GDP, right? So that would mean Q1 would be negative, Q2 would be negative, we're in a recession. Now by that time it's a little bit too late, but all we're trying to tell you here is yes, it's going to be a little bit slower, but still relatively positive and a lot higher than where it was 2 years previously. If this works. There we go. And now here's one that'll scare you a little bit. It scares me. It's really the only thing that I see as a potential negative. So there's the economic cycle and then there's the business cycle, right? Businesses are usually leading indicators of the economy. Mr. Christie, your business starts to slow down. That affects your business, Mona. That affects your business, Holly. That affects your business, Carol. And then it starts to bleed into the economy. You start to lay off some of your workers. She starts to lay off some of her workers. Now unemployment starts to tick up. And then that leads to slowing down of economic activity, right? So let me show you just what this is. That green line is wage growth, okay? That gray line is unemployment. As you can tell, they're inversely related. And why so? The lower the unemployment, the lower number of people there are to find jobs. So I use a simple example of this. If I'm hiring someone in 2012, 10, and I put an ad out in the paper, and I have 30 people show up for that job, I can offer them basically anything I want, right? Now, if I put that same ad in the paper, and only 2 people come, and only one of them's qualified, and they want more money than what I'm offering, I'm either going to have to wait those next few months or pay them more to get the talent that we need, right? So that's why they're inversely related. Less people out in the workforce available to work, the higher wages go, at least in the short term. But what I want to point out is when the unemployment rate finally hits the trough, which is what it looks like we're getting close to now, okay, right here. Only a few months after that, do we see a recession. You can see it every time. These are recessions. So every time it hits that trough peak, or when they almost invert, only a few months later, 6, 8 months later, a business cycle recession starts, and then a few months later after that, 6 or 12 months later after that, a recession starts. So that's one chart that I like to, not end with to make it doom and gloom, but just to really kind of give you the reality of what we look at. We don't focus on the headlines. We don't focus on, what CNBC is saying today or yesterday, or any day really. We focus a lot more on Bloomberg. They're just, generic and dry. But that it is the reality of where we're at. We're 10 years into this bull market, but what we know is bull markets don't die of old age. Okay, unlike human beings, there has to be a specific initiative or catalyst that causes either a business cycle to end, a recession to start, or some type of epidemic to really cause growth to stifle. So we generally see earnings coming down a little bit this year from 16% to about 14%, but that's still positive earnings growth. It's not negative earnings, okay? So this is something that we're watching for. And then if we go on, we're back to this chart, but this is 2019. So if I've seen you so far this year, which most of you I have, I told you roughly 10 to 17% is what we expect this year. Now if you look at what they consider themselves the professionals, the big institutional money managers, from Voya, Wells Fargo, Bank of America, Goldman Sachs, which is one of my favorite firms to follow just because they have all the power, 17.3 to 17.6% growth. Now remember what they did last year though, 4%, and we saw a negative 6, okay? So I just have to give that disclosure. Just because they make all of those billions of dollars doesn't mean that they're right in their forecast. But I tend to agree with something like this, 10 to 17%, based off of how far earnings analysts dropped their expectations last year going into the start of 2019. So roughly about 17% growth, but you have to keep everything in perspective is the most important thing. So we're almost wrapped up here, but this is the most important item. Most everybody in this room is going to be retired for the foreseeable future if they're not already retired now. And what I try to focus on when we build portfolios is not the markets, but the individual companies. So unless we're hedging risk through various forms of insurance for longevity purposes, we like to own U.S. large cap corporations. The companies that are changing the dynamics of what we're doing on a daily basis, the companies that you know are going to be there 5 or 10 or 15 years from now. Those companies, just as an example, Amazon, Apple, Home Depot, even Facebook, Netflix to a small extent, and it's because they're reinvesting all of their capital to make their company or their product addictive. And why that's a good reason is because if they do that successfully, they can inherently raise prices on consumers over time. And those are the companies that you want to focus on. There's a lot of jargon nowadays about passive investing, active investing, and at Wayland Financial, what we try to focus on is just actual investing. Back to what it was in the 1920s, when an entrepreneur had an idea and wanted to take risk on a business, and you looked at that business and that idea and put a price on the equity or the debt that you were purchasing. So we try to do the same exact thing by the companies we look at, not quarter to quarter, and not every 6 months, but are the management teams doing what they're supposed to do? Are the companies aligning themselves with their shareholders, and are they making progress to affect the world in a way that they can monetize on? So perspective is key. What this shows is the red dots, going back to the 1980s, are the intra-year lows. So for example, last year, the market at one point in time was down 20%. Where did it finish? Down 6%. Something I like to point out here, since the 1980s, 29 of 39 years have been positive. Okay, so if you're a numbers person, you play the odds, right? But the problem is, when you get here, or when you get here, or even here, as human beings, what are we? We're emotional, right? Everything we do, and it doesn't matter how strong you are, we mix emotions and investing, and that is never a winning strategy. So if there's ever a time that you get concerned over what you're invested in, what Reed's putting you in, give us a call, right? So keep us in the loop. These are some of the things we want you to commit with. Keep us in the loop on important lifestyle changes. Tell us about concerns that you have. We're always here with an open ear to answer any questions that you have regarding the portfolio. We don't put our clients' money where we don't put our money, so we know exactly what's going on with the actual investments. And it may differ, like I said, on if we shift risk to the insurance side, just because I'm too young. But on the equity side and the bond side, absolutely. And then the last thing, which is really important because we saw about 7 to 10 deaths last year at our firm. And it's just important to remember keeping your legal documents, checking on the beneficiaries every single year, because the best gift you could give to family members is a well-organized estate. So that's just something that we're trying to remind and preach to our clients as the years go on. Just make sure you take one meeting just to say, hey, are the beneficiaries exactly how we want them? Because it's just a simple form to update them if they're not. And then commitments from us. Keep you informed like this. I like the smaller group, it's nice. And a little bit more engaging. Manage your investments according to what we're trying to accomplish for each of you. And then stay on top of changes in the market. So if you're not getting our weekly market commentary, if you're not following us on Facebook where we post just interesting articles that we like, or if I go on to CNBC or US News and do something, go to Facebook, follow us just so you can get all the content. We don't bombard anybody, but it's just an easy way to reach everybody in this day and age. So, any questions? I mean, yes, Mr. Wilson.
Did the trade deficit numbers yesterday have any effect on you?
On the stock market?
On you and your general
thesis? No. I think that until... Yeah, I think until we get a resolution, but the problem with the trade tensions is how do we employ enough people to monitor China? But I think that we are starting to make some groundway with regards to the deficit with China, but we have to put our foot a little bit stronger on their throats because we control all the leverage, but it's just not nice for the stock market to go through those things. But no.
That was even in light of these.
Yeah, even in light of the tariffs. Anything else? I know you got a question, Mr. Roselli.
Yeah, this is for Carmela. How much do we need to contribute so you can buy another ream of paper and make them 2 up instead of 4 up?
Okay. Or we'll make it 1
2 up instead of 4 up.
I mean, is
That's
this
like-
time you're gonna raise our fees a lot?
Yeah.
For the paper?
Well, this year, because of inflation, yes, they all
paper.
go up, yeah. We said 2.2, right? We try to keep together with inflation, yeah. No other questions?
Now,
Yes, sir.
hypothetical,
Uh-huh.
let's assume they get a visa, and whatever that may be, straight here in Trump. How do you think that logs into your geopolitical, if they can move things around?
I think that if they can come to good terms with China and actually have an agreement, like I said, the tough thing is monitoring it. The month is a really busy, or March is a really busy month. We've got the Fed meeting March 23rd. Right after that, Donald Trump makes an announcement on China, and then March 29th. But I think if we get a successful trade deal through, that's a 12% ceiling on the S&P 500 that's been artificially held down. That'll bring us to about 17 times earnings, 17 and a half times earnings, which is a little lofty. But I think that at least 12% of the market's being held off by that. Only because we should be able to come to a negotiation where it makes it a little bit more fair, if that's how you say it, with regards to trade. Yeah. But geopolitically, still is a problem because of Europe. I think Europe is basically in a recession already. They've had 0 interest rates for 10 years. They can't figure it out. And it's just my belief because of the way they structure things. I mean, you can't, you can tax as high as you want, but if you, it doesn't make sense mathematically, right? So I was in France last year, and the gentleman who took us on a tour basically told me that he pays about 60% in taxes, with all the different things that are added on there. But despite all of that revenue that's being generated, you still can't grow an economy, and that begs the question on who spends the money better, the consumer or the government. And I'll leave that up to you guys. I want to mix politics and investing. But by all means, grab as much food as you want, stick it in your purse, we get to-go boxes. And if you have any questions or you ever come into the office, don't hesitate to stop by my office. All right? Thank you.
Thank you.
Thank you.